corporate valuation. Under that first concept, EVA, economic value added. EVA equals to NOPAT minus capital employed into weighted average cost of capital, or NOPAT minus capital charge. NOPAT equals to EBIT into 1 minus T. Capital employed or invested capital equals to equity share capital plus preference share capital plus debt capital book value. Here, operating capital employed is only considered. Non-operating capital employed is not considered while calculating EVA, economic value added. K equals to RF plus beta into RM minus RF, or D1 by P0 plus G. KD equals to capital into 1 minus T. Total equity or net worth equals to equity share capital plus reserves and surplus. Reserves and surplus is also called as other equity. Net income means PAT. The company with high EVA is best. EPS equals to earnings available to equity shareholders divided by number of equity shares. How to calculate NOPAT? EBIT minus non-operating income plus non-cash expenditure. Non-cash expenditure except depreciation less tax gives NOPAT, net operating profit after tax. Next, EVA dividend equals to EVA divided by number of shares. Next, market value added, MVA. MVA from company or firm's point of view, MVA equals to value of firm less operating capital employed. Next, MVA from equity shareholders point of view. MVA from equity shareholders point of view equals to value of equity less equity shareholder funds, where value of equity equals to MPS into number of shares, number of equity shares. Equity shareholder funds equals to equity share capital plus reserves and surplus. MVA is the present value of all future EVAs. MVA equals to market value less book value. Value of business equals to MVA plus operating capital employed. How to calculate MVA? Present value of future cash, future EVAs. Present value of future EVAs is MVA. Next, free cash flow approach. MP0 equals to D1 by K minus G, or D0 into 1 plus G divided by K minus G. D1 equals to D0 into 1 plus G. Free cash flow approach is used when firm does not issue dividend in the past and valuation is done for control purpose, that is merger and acquisition purpose. Free cash flows to the firm. Sales minus variable cost or cost of goods sold less fixed cost excluding depreciation gives EBITDA, less depreciation gives EBIT, less tax gives NOPAT, less capital expenditure less depreciation. Depreciation should be deducted from capital expenditure, minus change in working capital gives free cash flows to the firm. This capital expenditure less depreciation minus plus a change in working capital is called as a net investment. Combination of these two is called as a net investment. Next, free cash flows to the firm will be discounted by KO, weighted average cost of capital. Then we will get value of business, less market value of debt, less market value of preference share capital, plus surplus cash, plus fair value of other surplus assets gives value of equity. Value of equity VE. Value of business less market value of debt, less market value of preference share capital, plus surplus cash, plus fair value of other surplus assets gives value of equity. Next, free cash flows to equity. How to calculate free cash flows to equity? Sales minus variable cost or cost of goods sold less fixed cost excluding depreciation gives EBITDA, less depreciation gives EBIT, less interest gives EBT, less tax gives EAT, less preferential dividend gives earnings available, less preferential payment, principal amount of preferential payment, preference share capital, less debt repayment, principal amount, plus new preference share capital and debt issued, less capital expenditure excluding depreciation. Depreciation should be deducted from capital expenditure. Less change in working capital gives free cash flows to equity. This capital expenditure less depreciation plus change in working capital is called as a net investment. Next, this free cash flows to equity will be discounted by KE and we will get a value of equity. Value of equity plus surplus cash plus fair value of other surplus assets gives total value of equity. Total value of equity plus market value of debt plus market value of preference share capital less surplus cash, less fair value of other surplus assets gives value of business. Next one, enterprise value, EV. Enterprise value, how to calculate enterprise value? Market value of equity plus market value of debt plus market value of preferential capital plus non-controlling interest minus surplus cash or cash or cash equivalents. Cash and cash equivalents gives enterprise value. How to calculate operating enterprise value or core enterprise value? Enterprise value less non-operating expense, non-operating assets or non-core assets gives core EV, enterprise value, or operating EV, operating enterprise value. How to calculate cash flow after tax? NOPAT plus depreciation gives cash flows after tax. Next, there are 4 ways to calculate value of equity. Value of equity equals to value of firm less market value of debt. Second way is PAT plus depreciation divided by KE. Third way is value of equity equals to PAT into price earning ratio. PAT into price earning ratio equals to value of equity. Fourth way, free cash flows to equity for 1 year divided by KE minus G. These are the 4 ways for calculating value of equity. There are 4 ways to calculate value of the firm. First way, free cash flows to the firm for n years divided by KO minus G. This is a terminal value of the firm. This is nothing but terminal value of the firm. Free cash flows to the firm for n years divided by KO minus G. Second one, PAT divided by capitalization rate. Third, PAT plus depreciation plus interest divided by KO. Fourth, EV divided by EBITDA multiple into EBITDA. EBITDA should be in numerator. That is numerator EV, enterprise value, into EBITDA divided by EBITDA multiple. These are the 4 ways for calculating value of the firm. Net assets or book value. Net assets or book value can be calculated by 2 ways. First one, total assets minus long-term debt minus current liabilities gives net assets or book value. Second way, share capital plus reserves and surplus gives net assets or book value. Earnings, value of equity equals to EAT divided by KE. Value of the firm equals to EBIT into 1 minus T divided by KO. On the basis of market price, market value, that is value of business equals to MPS into number of shares. In case of discounted cash flows, present value equals to summation of cash flow for T years into present value factor for T years. In case of shareholders value added, we will calculate value of equity. There are 5 steps. First one, step 1, calculate future cash flows. Step 2, discount future cash flows with KO, weighted average cost of capital. Step 3, add terminal value to step 2. Step 4, add market value of non-core assets. Step 5, reduce value of debt. Step 5, reduce value of debt, which will give value of equity. So, calculate future cash flows, discount with KO, add terminal value, add market value of non-core assets, reduce value of debt, will get value of equity. Next, on the basis of price by book value ratio, value of a firm equals to market value of the value of equity equals to market value of equity divided by book value. Next, on the basis of price or sales ratio, value of equity equals to market value of equity divided by total sales. On the basis of price or price by cash flow ratio, value of equity equals to market value of equity divided by cash flows. Next, profit capacity capitalization method or FMP capitalization method. Future maintainable profit capitalization method. Profit capacity capitalization method or future maintainable profit capitalization method. Value of business or value of firm equals to future maintainable profit FMP divided by capitalization rate. FMP, take average of, how to calculate FMP? Take average of past years profits, that is PAT, convert this past profit into PBT. PAT minus tax gives PBT, plus or minus non-recurring and extraordinary expenses and losses, plus or minus non-recurring and extraordinary incomes and gains, will get FMP, future maintainable profits before tax, less future tax at the rate of future tax rate, calculated at the rate of future tax rate. Future tax calculated at the rate of future tax rate gives FMP, future maintainable profits after tax. Next, EV by sales multiple. EV by sales multiple. In such a case, how to calculate value of business? Value of business equals to EV, enterprise value divided by sales. How to calculate EV? EV equals to EV divided by sales multiple into sales. Next, chop shop approach or breakup value approach. As per this approach, value of firm equals to PAT into capitalization rate divided by N plus net assets into capitalization rate divided by N plus sales into capitalization rate divided by N. Next, gearing of beta. Equity beta equals to change in equity divided by change in economy. Overall beta or asset beta. How to calculate overall beta or asset beta? Overall beta or asset beta equals to beta of equity into equity divided by equity plus debt plus beta of debt into debt divided by equity plus debt. If question is silent, assume beta of debt is 0. If T is given, that is tax rate is given, then take a debt equals to debt into 1 minus tax rate. If question is silent, overall beta or asset beta is same for all companies provided they have same capital structure. Next, gearing level. Gearing level equals to debt by equity ratio. It is calculated using market value. Gearing level means debt by equity ratio. Comparable company analysis. Value of company. In case of comparable company analysis equals to company's PAT into average sector price earning ratio. Yield method. Using yield method, we will calculate value of equity. Value of equity equals to actual yield divided by expected yield into paid up value per share. Actual yield equals to yield to equity shareholders divided by paid up equity share capital into 100. Yield equals to PAT minus preferential dividend. Expected yield percentage equals to industry rate of return. Debt ratio equals to debt divided by debt plus equity into 100. Levered beta. Beta levered equals to beta unlevered into 1 plus debt by equity into 1 minus T.